Ladies and gentlemen, it's a great pleasure to be here. Thank you for the invitation. Thank you very much for the kind introduction, Mrs. Frauenknecht. In my talk, I would like to touch upon some issues which I consider of great importance for you as professional investors. And as you will see, I will take the perspective of the investor rather than of an economist. And why is that? It is because I act as an advisor to an investment fund, like Mrs. Frauenknecht said, which I co-founded in 2012. I'm therefore quite keen to point out where macroeconomic considerations are useful and where they are irrelevant for the seasoned investor. And without further ado, let me start on a positive note. On this chart, you see the major economies of the world are expanding. Real GDP in the US, the Eurozone, Japan, and the UK has well surpassed pre-crisis levels. And perhaps even more important, leading indicators suggest that economic growth rates should remain positive for the foreseeable future. The Chinese economy is showing signs of improvement as well, as suggested, for instance, by the latest business cycle indices, which have gone up substantially since around the beginning of last year. The outlook for higher economic activity in China seems to help commodity prices to bottom out, as China is by far the world's most significant consumer of raw materials. All in all, the world economy seems to be up and running again. Growth rates are not stellar, but certainly in positive territory. I venture to assume you want me to say, watch out. The presidency of Donald John Trump will most likely bring far-reaching changes, not only for the US, but the entire world, with effects we are just beginning to understand. You are quite right in this respect, and this is what I want to say. President-elect Trump made pretty clear that he is not an internationalist, like his predecessors, Bill Clinton, George W. Bush, Barack Obama, or his competitor in the presidential election, Hillary Clinton. Mr. Trump does not wish to crusade, does not want to harness America's exceptionalism to bring about a new world order by political and military means. There is no global anthem, no global currency, no certificate of global citizenship. From these words, I deduce that the future US foreign policy might be much less interventionist and militarily aggressive than it has been in the past. I think we have good reason to hope that this attitude pays off when it comes to international politics, as far as, for instance, US-Russian relations are concerned. Americans voted for Donald Trump to make America great again. They long for better jobs, for more jobs and higher incomes. One way Mr. Trump can live up to this campaign promise is to redirect imports in and exports out of the US. There is an idea that is making its round in the Beltway, namely making imports no longer tax deductible and scrapping taxes on US exports. The effect would be that first, foreign firms get an incentive to move production to the US, and second, US exports would become more competitive, allowing US producers to gain world market share. There would be less US dollar debt because it would shrink the trade balance in the US for financing the trade deficit, and more dollar demand from abroad to finance investments in the US. In total, this should be US dollar positive. And in the short term, redirecting foreign trade flows this way would surely benefit the US while putting quite some pain of adjustment on other countries like China and Germany. In the long term, however, the effects would be negative because world production would no longer take place in locations economically best suited for the task. output would remain below potential and production prices would certainly go up. A more powerful and economically reasonable tool is Mr. President-elect Trump's plan to cut taxes. According to the Tax Policy Center, an American think tank, Mr. Trump is about to hand back $9.5 trillion, that's around half of US GDP in 2016, back to the people over the next decade. $9.5 trillion. It would certainly have a positive and substantial effect on corporate earnings and the return on investment, thereby boosting production and job creation. It would also make the US more attractive for international enterprises, giving them an economic incentive to move production to the US. And moreover, lower US corporate tax rates could trigger a worldwide reduction in taxes. Just think of the UK already toying with the idea of lowering taxes following Brexit. 2/3 of the tax cuts delivered by Mr. Trump would benefit individual income earners, giving them more money for consuming, for saving, and investing. Now you ask, what does that mean for the US budget? The US budget is estimated to add 2.8 percentage points to the US fiscal deficit in 2017, rising to around 4 percentage points in the years thereafter. These numbers, however, do not account for the positive impact tax cuts have on growth and employment. The so-called Laffer curve effect may well come to the rescue. The Laffer curve essentially says that if taxes are too high and you cut taxes, you stimulate the economy and generate higher tax revenues. Lowering taxes can therefore be regarded as more of a chance than a risk. Money in the hands of firms and consumers will almost certainly be spent more wisely and productively than through government. Mr. Trump has campaigned on the promise to dry the swamp in Washington, or in more diplomatic terms, to roll back big government. If he lives up to his promise, extensive budget cuts would also be a means for reining in the budget deficit. In this context, we should take a brief look at the relation between the US budget deficit and changes in employment, which you see on this chart. The two lines are positively related, so if employment goes up, the rate of employment goes up, the deficit shrinks because higher employment, of course, lowers the need for spending Social Security and increases tax revenues. If Mr. Trump's plan works out and results in higher growth, an additional 1.2 million jobs per year can be created, and that would translate into an additional employment growth of 1 percentage point. So overall, I'm inclined to think that concerns about a ballooning US deficit and a spike in inflation because of it are overblown. We should factor in that Mr. Trump and his entire team are very much pro-business, as suggested by their explicit endorsement of the work of, for instance, Ayn Rand, the novelist and libertarian heroine who celebrated laissez-faire capitalism. You may have read the book Atlas Shrugged. So cutting taxes and doing away with red tape might not be popular with certain political pundits. However, I lean towards thinking that Mr. Trump's approach offers a real chance to promote growth not only in the US, but in other parts of the world. When we talk about investing in times of boom and bust, there's no way of getting around a somewhat delicate issue, and that is fiat money. Fiat money is the big gorilla in the room. It is so big that most people would not even see it. Please allow me to explain. The US dollar, the euro, the Chinese renminbi, the British pound, the Swiss franc are all fiat monies. Fiat money has three characteristics. It is produced by state-sponsored central banks, which hold the money production monopoly. Second, fiat money is created through bank lending, which means it is created out of thin air. And third, fiat money is intrinsically valueless, representing colorful pieces of paper and bits and bytes on computer hard drives. By all means, fiat money, you may also call it irredeemable paper money, is far from being a natural or harmless institution. The American economist Milton Friedman put it succinctly. He said, quote, "A world monetary system has emerged that has no historical precedent, a system in which every major currency in the world is on an irredeemable paper money standard. The ultimate consequences of this development are shrouded in uncertainty." Quote ends. Fiat money causes quite a few economic and ethical problems. First of all, it is inflationary. It loses its purchasing power. Take, for instance, the euro. Since its introduction at the beginning of 1999, it has lost around about 27% of its purchasing power in terms of consumer goods. Fiat money benefits a few at the expense of others. What is more, fiat money causes boom and bust. It sets into motion economic expansions and speculative frenzies that will and must eventually collapse. Fiat money also raises the debt ratio, as you will see in a moment. And finally, fiat money makes government become bigger and bigger, and this is because fiat money provides them with financial means well beyond their regular tax incomes. Let us take a look at the inflationary impact of fiat money. On this chart, you see the growth rate of money supply and consumer prices in the OECD since January 1980. The two lines trend on the same wavelength, and so higher money growth is accompanied by higher consumer prices. Since around the end of 2014, money supply growth has gained momentum, and with a time lag, consumer price inflation has started to pick up. As it is very likely that central banks will keep churning out new fiat money, we may well conclude that consumer price inflation is moving further up. In this context, let us take a look at what financial markets think about future inflation. Here you see inflation expectations in the US, the Eurozone, and the UK, illustrated by five-year inflation swap rates. Inflation expectations have started to pick up since the beginning of 2016, and from this we may conclude that financial markets expect consumer price inflation to return to normal in the coming years. There's no further deflationary concern, obviously, in financial markets. For you as an investor, however, it is important to note that inflation, which is a symptom of a rise in the quantity of money, can take various forms. It may emerge in the form of rising consumer prices, but it may also manifest itself in the form of higher asset prices. On this chart, you see the real estate prices in the US, the Eurozone, the UK, Japan, and China. With the exception of Japan, real estate prices have gone up quite substantially since the 1990s. Asset price inflation, here exemplified by real estate price inflation, has well outpaced consumer price inflation, resulting in a devaluation of currencies which most likely exceeds what most investors expect. I already mentioned that fiat money causes boom and bust. From the early 1970s to December 1989, when the Nikkei stock market index hit 39,000 points, the Japanese stock market rose by a spectacular 14% per year on average, with land prices increasing by 7.4% and consumer prices by 5.4% per year on average. Until December 2016, Japanese stock prices fell by 59%, land prices dropped by 63%, and only consumer prices went up by a total of 6.5%. Investors should heed the Japanese experience and should interpret it as a mild version of what may happen if and when the fiat money frenzy blows up in all our faces. Fiat money makes economies, as I said, run into too much debt. On this chart, you see the US federal fund rate and US total debt in percent of GDP from the early 1960s until the end of 2016. When you look at the beginning of the 1980s onwards, the message is straightforward, as I think. Interest rates down, debt goes up. And you can observe this phenomenon in basically all countries that have employed fiat money. To prevent the debt pyramid from coming crashing down, central banks keep pushing interest rates to ever lower levels. And as the economy is getting used to very low interest rates, it becomes difficult, very difficult, to bring interest rates back up. Central banks, with their policies of churning out fiat money, caused the economic and financial debacle 2008-2009 in the first place. The response to the crisis was even lower interest rates and more fiat money, and the continuation of the latest economic recovery, I pointed out to you, rests on keeping interest rates at fairly low levels. The power of central banks is not unlimited, but investors, you as an investor, should expect them to remain quite powerful for quite some time. Nevertheless, central banks' room for maneuvering has decreased. To demonstrate this, I would like to show you this chart. It shows the S&P stock market index and the shape of the US yield curve, that is 10 years minus 2 years rates in percentage points. The shaded areas represent periods in which the yield curve turned negative, so long-term interest rates fell below short-term interest rates. When the yield curve became negative, the stock market nosedived. Why? As you know, banks lend long-term and finance themselves with shorter maturities. If the yield curve starts flattening out, lending becomes less profitable. Banks become hesitant to refinance maturing loans and to increase the credit book. By hiking interest rates, the Fed pricked the stock market bubble in 2000 and 2001, and also pricked the credit bubble in 2008 and 2009. This is not to say that the shape of the yield curve would be the only significant factor in determining the direction of the stock market, but I would think a positively shaped yield curve appears to be a necessary condition for preventing another bust, and this goal ranks very high on central banks' priority list. Also, keeping interest rates low is at least equally important. This is because by cutting interest rates, central banks have succeeded in dispelling credit default concerns from the markets. They have, for instance, managed to lower CDS spreads for bank debentures markedly since the end of 2012. As a result, investors have returned to credit markets. By the way, I'm inclined to think that the credit market is possibly the most distorted financial market segment of all. Low interest rates and at the same time a relatively steep yield curve are indispensable, I argue, for keeping the fiat money boom going. This is why central banks are already effectively controlled the yield curve from the short to the long end of the market. This is not a new policy. It was the same policy that was put into place during World War II. As from 1942 onwards, the Fed kept interest rates at around about 40 basis points at the short end of the market, and the long-term yield at around about 2.5%. The Fed monetized government debt, increased the quantity of money, and drove up inflation. Interest rates became negative. Negative interest rates helped in turn to lower the US GDP debt level. which was at around about 120% of GDP in 1946, down to around about 70% in the early 1970s. History does not repeat itself, but it does rhyme at times. Currently, it is expected that the Fed will raise rates to around about 1.5% by the end of this year, and with 10-year Treasury yields remaining at around about 2.5% to 3%. And I'm inclined to think that financial markets are correct as far as their expectations on Fed policy is concerned. In Europe, the major flashpoint is the euro banking system. It is the largest in the world, with a balance sheet of a total the balance sheet total is around about 34 trillion euro, and that accounts for around about 322% of GDP. By way of comparison, the US banking system is much smaller. It's just around about 16 trillion US dollars, or an equivalent of around about 85% of GDP. Many Eurozone banks are suffering from low profitability, non-performing loans, and a rather thin equity base. The ECB has successfully fended off a liquidity crisis. If, however, a solvency crisis would rear its ugly head, things could get problematic, quite problematic. One way to deleverage and shrink Eurobank's balance sheet is to opt for an opt-in, preferred by the Germans, which means wiping out bank liabilities. How problematic that would be. A case in point is the Italian bank Monte dei Paschi di Siena. A debt for equity swap is now in store for the bank's bondholders. Tier 1 security, as you know, receive bank stocks that represent 75% of nominal bonds. Tier 2 bonds will be converted at 100% of nominal value and will be later converted into senior bonds. Of course, it will ultimately be paid by the Italian taxpayer and by the money holders in Europe, because if the Italian government issues bonds for financing these banks, they will presumably be bought by the European Central Bank against issuing new money. Politically speaking, there is a superior solution, and that is inflation. The idea was brought into the open by ECB President Mario Draghi in July 2012, when he said, quote, "The ECB is ready to do whatever it takes to preserve the euro, and believe me, it will be enough," quote ends. Since Mr. Draghi spoke these words, the ECB has cut interest rates to zero, and the ECB deposit rate has been pushed into negative territory as from June 2014. In January 2015, the ECB announced it would purchase corporate debt and government debt in the amount of 1.14 trillion euro as from March to autumn 2016. In the meantime, the program has been expanded. The question is, where will all this lead to? To provide an answer to this question, you may want to look at this chart. It shows you the overnight deposits, that is the dark line, held with Eurobanks. They amount to around about 6 trillion euro at the end of last year. The orange line shows Eurobank's liquidity in form of central bank deposits, which amount to around about 1.5 trillion. In other words, there's a funding gap if and when people would turn up at their bank and demand a cash payout. So you could also say Eurobanks are quite vulnerable to a bank run. And to close the gap, the ECB must inject further liquidity. This can be done by purchasing more bonds. It would actually allow to transfer around 50% or even more of euro government debt onto the ECB's balance sheet. A credit event in Europe can most likely be prevented. But the ensuing expansion of the money supply, and it may well become substantial, can be expected to push up prices in the years to come. By that I mean consumer prices and or asset prices. I would think that ECB rates will be kept unchanged this year, and I would venture also assume that rates remain unchanged next year. What does it mean for the euro, for the euro's external value? The euro is already a currency in trouble. National political developments, as you know, in the EU countries suggest a rising probability of the European integration project unraveling. This year, key elections will be held in Germany, France, and the Netherlands, in countries where citizens' disenchantment with the political establishment and the single currency is already rampant. Growing uncertainty about the fate of the euro would weigh down on its external value. For if the EU disintegrates, the euro will lose all its economic and political support. I wouldn't be too surprised if the euro, which currently trades at 107 against the US dollar, would trade lower this year and in the years to come, especially against the US dollar. It seems that central banks' motto is keep it going. They will most likely continue to churn out new credit and money. And this is certainly one of the drivers of the stock market, as you can see in this chart. As you can see, the S&P 500 and US bank credit since the beginning of 1990. In an environment of ongoing moderate economic expansion, relatively low interest rates, and an ongoing rise in credit and money, prices in asset markets, stock markets in particular, should benefit. The risk premium in the US stock market, and I calculated the risk premium by using the S&P earnings yield and the short-term funding yield in the US, has moved to a fairly high level. And that tells us that the Fed's policy of low interest rates has not driven up stock valuations in the first place, but in particular the risk premium in stock markets. And this would suggest that even if interest rate would creep up a bit, a decline in the risk premium could actually keep up current stock market valuations. Ladies and gentlemen, we have been discussing quite a few issues so far, and now the pressing question is, what does it mean for you as an investor? How can you navigate the challenges and take advantage of the opportunities that come with them? For quite some time, I have outlined to people the problem of fiat money and what it does to the savings and capital invested. And this made a growing number of people asking me for advice. What should I do with my money? And around about 6 years ago, I started to look for an answer. I studied in greater detail what the most successful investors have been doing, and I tried to find out, as I call them, timeless principles of sound investing. What I found to be one of the most convincing principles was coined by investor legend Benjamin Graham. He said, quote, "Investment is most intelligent when it is most businesslike," quote ends. Most important, I found out that investing in so-called great businesses actually provides, I would say, a perfect solution for meeting the challenges that come with the global fiat money regime. Great businesses are typically inflation resistant, and they are well positioned to weather boom and bust. Investing in great businesses allows you to take advantage of the miracle of compounding capital. On this chart, you see the S&P 500 from 1977 to December 2016. The S&P compounded at an annual rate of 7.5% per year on average in the period under review. I also put in the performance of a great business that has compounded at close to 12% per annum on average. And what a difference it makes over time. Since I had the conviction and a desire to put my findings into practice, I teamed up with a very dedicated value investor. And together we set up a fund, the P&R REAL VALUE fund, which I just support as an advisor. And this table shows you what we have achieved so far. For instance, in 2016, the fund was up 8.5% against close to 9% of the MSCI world. I would be happy if you find these ideas fruitful for your own investing, and in case you just want to learn more, you may visit polleit-richard.com. Ladies and gentlemen, unfortunately, my speech has to end here. I would be pleased if I succeeded in providing you with some stimulating and hopefully useful guidance when it comes to investing in times of boom and bust in 2017 and beyond. Thank you very much for your attention.
Any questions from the audience? Anyone who disagrees or agrees? If not, let me start with one question. You seem to be quite critical of fiat money and its implications. So would gold be the better currency? Is gold perhaps the best currency?
Well, yeah, as you rightly say, I'm quite critical about the fiat money system because I think it causes a lot of problems for a lot of people. And it is not a sustainable monetary order. But I'm quite optimistic that we as a whole, we people, will create something new which is better. Whether it's gold, I don't know. Gold has been the ultimate means of payment for thousands of years, so it would be a kind of natural candidate for an alternative money. But we also have Bitcoin, a new candidate competing for the status of money. The blockchain technology can actually be used via so-called colored bitcoins to digitalize gold. We have to see what comes out of it. And the best thing we can hope for is a kind of competition in the markets for money. And I think that's coming in the years to come. Maybe not in 2017, but further down the road, people will look for better and sound money. And I'm quite hopeful we end up with a better system.
You also said that you believed the financial markets were right about in their betting about future Fed monetary policy. What about the ECB? When do you believe that we'll see a normalization of rates in the Eurozone eventually?
As I tried to point out, there are quite some problems in the Eurozone in terms of politics and economics. The debt load has got up quite substantially in recent years, and I find it really difficult to see that we are going to return to normal levels, ever. A kind of Japanese-style scenario seems more likely from my point of view. So an interest rate normalization, bringing rates to historically normal levels, is quite unlikely from my point of view. In any case, interest rates in real terms should remain close to zero or even go down to into negative territory. So I'm skeptical whether you as an investor in terms of buy and hold strategies end up with a positive return on capital in real terms. So that's the reason why the bond market, from point of view of a long-term investor, is not my favorite market. I think going forward, decent returns on capital can be earned by investing in great businesses. There are great businesses in this world, and I think investors should take advantage of it. And that is, as I think, the best solution, the best hedge, so to speak, against the vagaries of fiat money in the years to come.
I.e. stock market and individual stocks, individual companies.
Yeah, not the stock market as such, but to be very selective. There are businesses out there which are quite interesting. You know, just if you, for instance, share the concern that at some point in time there will be inflation, and you would conclude from that, well, then I buy, let's say, a stock market ETF or whatever. When you look back in history, you find that investing in stocks is not per se a protection against inflation. For instance, in the early 1970s, in the US, for instance, the increase in stock prices was lower than the rise in inflation. So you couldn't actually preserve your capital. But by investing in, as I call them, inflation-resistant businesses, you can preserve and even increase your capital in real terms. That's I think, something we all have to think about.
We have a question from the audience in the second row. Perhaps a microphone. Thank you.
I'm curious to know if you analyzed the structure of the debt, because it seems to me that it's good to take debt on when it's cheap, especially when you're talking about increasing equity valuations, because they will need capital to expand. And so is it good that we have a lot of debt for equity valuations going forward, or is it all, you say, like empty money?
Yeah. Don't get me wrong, I have nothing against credit. I think it's a wise source of funding. No problem with credit as such. My critical remarks relate to analyzing our monetary system. And if, for instance, banks issue new credit, they create money out of thin air, and that causes various problems. That brings also problems to the corporate world. And of course, from an investor point of view, if you, for instance, a corporate, it might be attractive at some point to take up additional debt at low interest rates if your total return on investment exceeds the funding rate. Know about that. But the problem with fiat money is that it stimulates an artificial boom. It makes companies, opting for the wrong investment decisions. And that's why you get all these boom and bust cycles. And here lies the problem. And a further remark, as I tried to point out, the debt per GDP creeps up over time in all currency areas that employ fiat money. And that's certainly an unsustainable development. It may go on for a couple of years, but at some point, it cannot diverge any longer or any further. And then the adjustment process kicks in, and that means presumably quite some turbulence, not only for financial markets, but also for the corporate sector. Yeah.
Just another question toward the debt. Now that the tax rules of the US might change, that might prompt US companies to bring back cash, which now that in the US, they have, like we see with Apple, they have big loans in the US to finance growth when they have billions outside the US. Yeah. So why do they lend money? It's just because they don't have the money in the US. They have it somewhere else. Now, if the tax rules are changed, as Trump wants, and want to bring that back, that would decrease the levels of debt for the US companies and make them less sensitive. Would that be a long-term sustainable strategy for reducing risk as you're talking about now?
According to data available, quite a number of US companies have dormant cash outside the US, and for tax reasons, they cannot repatriate the money to the US and put them into investment. That's going to change as far as I'm informed, under Mr. Trump's tax cut plan. Whether that makes a huge difference in how, in the size of the outstanding US debt level, I doubt. The number is not as big as you might think. But it's certainly for the companies which enjoy lower taxes and can repatriate their funds, it's of course beneficial, for sure.
There's another question in the back.
Mr. Draghi announced last year to reduce the quantitative easing in Europe. You think this is still realistic or wishful thinking, and what would be the impact on the market if it does?
Yeah, thank you for your question. As you say, the monthly purchases have been reduced from 80 billion down to 60 billion. One reason I assume is that they have problems with the upper limit, the issuer limit. They just can buy up to 33% of an outstanding issue. And buying 60 billion is enough for keeping interest rates at fairly low levels. And so I think it's more kind of strategic decision, but I cannot. I personally don't interpret the decision as a kind of tapering coming sooner or later. I think the debt level, especially the problems in the Euro banking system, require the creation of lots and lots and lots of liquidity. And so Mr. Frauenknecht asked me about interest rates. I think they're going to stay rock bottom for quite some time.
Okay, we have to leave it here. It's been a pleasure. Thank you very much for your insights. Thorsten Polleit, everyone.